Welcome to Your Wealth Matters. I'm Janet Kim Singh, Portfolio Manager at Capstone Asset Management, and today I'm joined by my fellow colleague and Portfolio Manager on the Private Wealth team, Maria Dawes. Today we're going to discuss different types of investment vehicles and a short explanation on each of them. I have to warn in advance that while this list is not exhaustive, hopefully it'll give an idea of the more commonly used investment vehicles and the ways in which they are used. We also have a very special announcement at the end of our video, so be sure to watch till the end to find out more. So the four investment vehicles that we'll be focusing on today include individual stocks and bonds, mutual funds, pooled funds, and exchange traded funds or ETFs. Maria, why don't we go through them as I've listed? So let's start with investing via stocks and bonds. What does this look like, and what are some of the benefits of investing directly in this way?
Hi, Janet. And sure, I'm happy to start there. So, stocks and bonds can be bought within any trading or brokerage account, and this can be bought outright by yourself, the investor, or on your behalf by a stockbroker or an investment advisor who is making the purchases on your behalf. So, when you own a stock or a bond individually, this means that any gains or losses are fully attributed to the owner yourself, and that includes any income or dividends. So, an example of owning a stock outright could be something such as owning 10 shares of an Apple stock. At Capstone, an example of owning individual stocks is through our Canadian Equity Income Strategy, which launched in 2022, and it's managed in house by our senior portfolio manager, Paula Carter. So now for bonds, you can hold corporate bonds or government bonds like municipal or federal bonds, or actually any other type of bond for that matter. But there is a vast variety out there. So investors tend to focus, though, on stocks typically, but it's worth knowing that outright stock and bond ownership is possible to construct a portfolio in this way. So, a few things to know when you buy a stock or a bond. Typically, there's a transaction or trading fee, either per trade or per share purchased. And come tax time, you would receive a trading summary of all the trades that you made during the year. In addition to that, you will have likely received some income from the holdings that you would have to pay tax on. And assuming this was done in, of course, an unregistered account. And it's worth noting that an advantage to Canadian taxpayers is that if you hold Canadian stocks that issue eligible Canadian dividends, these would be taxed at a lower rate. So that's something to consider as well. Another great benefit to individual stock ownership is that you can at times be strategic in using capital losses to offset capital gains. And lastly, if you donate to a Canadian registered charity, a stock with a large capital gain attached can receive a tax receipt equal to the fair market value of the security being donated, while foregoing having to pay the tax on the gain. So that can be extremely beneficial when you're making financial gifts. And that said, I do want to acknowledge that the recent federal budget has changed the strategy a little bit and made it less effective for high income earners. So it's still a good opportunity for tax planning, but you should consult your accountant on the benefit as it directly applies to you. So that's the first type that we can invest in. So just again, a brief overview. Janet, why don't you cover off the next one, which is mutual funds?
Yes, mutual funds. Mutual funds are another type of investment vehicle whereby investors' money is pooled together in order to purchase securities. These are also fairly accessible to the mainstream investor through any brokerage platform, and these package investment products may contain stocks and or bonds as their underlying holdings. But the main difference is that it is packaged within the mutual fund. It's also possible for a mutual fund to have several funds as its underlying holdings. So there are a lot more possibilities here. Mutual funds tend to be managed by large investment corporations, and whatever you're interested in, it likely exists, whether that be Canadian equity funds, US dividend funds, Asian growth funds. The possibilities are pretty much endless here. So it is a great vehicle for getting some diversification, which would be a bit more difficult if buying only individual stocks and bonds. And because these tend to be actively managed by large management investment firms, there can sometimes be a hefty management expense ratio or MER attached. So it is something to be aware of. Thankfully, all of this is published and readily available so you can know before you potentially make that purchase. Um, Now, because you own units of the fund, you are taxed on the distributions of income that get flowed out to you, and that would come out on a T5 slip come tax season. Those distributions could be from capital gains dividends, foreign income, interest, other income, return of capital, or some combination thereof. And if you were to sell some of these units, this would be a taxable event resulting in a capital gain or loss. Again, assuming this is done in a non-registered account. And similar to the case for individual stock and bond ownership, you'd receive that T5008 or trading summary showing this. Okay, Maria, we've discussed now 2 of the 4 investment vehicles we set out to introduce. Why don't you walk us through mutual fund trusts, or what we tend to call pooled funds?
Okay, so mutual fund trusts or pooled funds are another popular investment vehicle in Canada due to favorable taxation laws. And if you're a Capstone client, you likely have direct experience with this because most of Capstone funds are, in fact, operated as mutual fund trusts. A pooled fund is similar to a mutual fund in that funds are pooled from many individual investors, which are then aggregated for the purpose of investment. And the investors become unit holders of the fund. A difference in the structure means that instead of a T5 slip, as in the case of a mutual fund, you would be issued a T3 slip reflecting the income or distributions flowed out to the investors from the trust. The trust part of the name also indicates that there is a trustee holding the assets on behalf of the investors. So again, the contents of mutual fund trusts could be varied depending on the firm's offerings. And at Capstone, for example, we have 5 different types of mutual fund trusts, ranging from our non-traditional funds, such as our mortgage funds, to our more traditional offerings, including our traditional equity fund. It's worth pointing out that in Canada, most mutual funds are actually mutual fund trusts. I also just want to briefly mention that Capstone also has a limited partnership fund, which is a lesser commonly used vehicle, as it is not eligible for registered accounts and results in a T5013 slip at the end of the year. As a limited partner in an LP fund, you are owning a percentage of the fund and are taxed accordingly. And while I know it wasn't one of the 4 vehicles we set out to speak about, I at least wanted to mention it briefly. So now, last but not least, Janet, why don't you talk about ETFs?
So ETFs are exchange traded funds that tend to track a market index. And because of this, most tend to be passively managed. This also means that the fees are lower and sometimes significantly so compared to those associated with mutual funds. And as a result, it can be a very practical way for gaining exposure to a certain market, which would otherwise be either inaccessible or inefficient. Unlike mutual funds or mutual fund trusts, ETFs are traded on a stock exchange, just like stocks and bonds, except that instead you are owning a basket of individual stocks and bonds. So ETFs, you could say, fall somewhere between owning a stock outright and buying a mutual fund. They have grown in popularity over the past several years, and pretty much any area you are wanting access to, an ETF likely exists for that. Now, this part is important. One thing we don't yet have in Canada is a biblically informed ETF, which takes the principles from the Bible in order to make biblically informed decisions when it comes to investing. But that is exactly what Capstone is setting out to do in 2024. So please stay tuned for that.
That's right, Janet. And that's our special announcement. And we'll have a more formal notice out at a later date, but this is a sneak peek for our dedicated viewers. For now, we hope this segment has been helpful, and while not exhaustive, it's a good start to some of the investment vehicles that you may have access to. We wish you the best, and please stay tuned for our next edition of Your Wealth Matters next month. Take care, everyone.
Bye.